We want to turn now to our other big story, the banking crisis. We go to Boston and Democratic Senator Elizabeth Warren. Good morning to you, Senator.
Good morning.
We saw this multi-billion-dollar attempt by the biggest banks to shore up one of the regional banks, First Republic. And even that hasn't stopped the anxiety in the banking sector right now. Do you think that in order to stop the bleeding, one of those big banks, too big to fail, needs to be able to buy up that smaller bank?
So I think that right now what we're trying to do is figure out the different ways to shore up these banks.
Do you need to allow for a merger? And is there any other white knight who could come in to save one of these regional banks, like First Republic?
Look, right now, the one who's saving all of these banks is the federal government. And the
First
federal
Republic's
government
still
is doing
living.
it through
It's still an actively traded company. It's not a failed bank.
I understand that. The point is, right now, the Treasury Department, the Fed, all of the government regulators, the FDIC, are trying to fire on all cylinders to try to figure out what they can do to prop up these banks. And the point I was trying to make is the reason they're doing this is because this whole tranche of banks has been under-regulated for 5 years now. And people are very concerned about when you lift the hood, what's under the hood, since the regulators clearly have not been on top of their job. It's
so
the reason that I'm calling right now for changes in the Fed in its regulatory approach and changes in Congress so that we roll back the authorization to lighten those regulations.
Well, I know there's some dispute on the regulation. You're talking about a tweak in 2018 to Dodd-Frank, and I know Barney Frank, one of the authors of that original regulation, is a dispute with you in regard to what actually happened here. But I want to talk about the now.
I wouldn't call it a tweak.
Well, Senator, though, I want to ask you about what Congress can do now, because it would be up to Congress to lift the FDIC insurance levels for those deposits above $250,000. In this environment we are in, do you think there's will in Congress to do that?
I think that lifting the FDIC insurance cap is a good move. Now, the question is, where's the right number on lifting it? But recognize that we have to do this because these banks are under-regulated. And if we lift the cap, we are requiring or relying even more heavily on the regulators to do their jobs.
Where would you lift that cap to?
The government is backing them up.
And
this
for how long?
This is a question we got to work through. Is it 2 million? Is it 5 million? Is it 10 million? Small businesses need to be able to count on getting their money to make payroll, to pay the utility bills. Nonprofits need to be able to do that. These are not folks who can investigate the safety and soundness of their individual banks. That's the job the regulators are supposed to do.
Well, I want to get to that particular point in a moment, but back on this, are you talking to the White House currently about a proposal on lifting the FDIC insurance levels? Are they asking you to do that? And is this possible to pass?
I don't want to talk about private conversations, but I will say it is one of the options that's got to be on the table right now.
There were already, requirements and public disclosures here, and there were flashing red lights. In December, SVB reported to the SEC it had no interest rate hedges on its bond portfolio. In March, the San Francisco Fed, this is publicly available, noted the banks in that district had the largest pace of decline in withdrawals in the country, perhaps due to higher exposure to accounts above $250,000. So this was already out there in the public space. Why didn't the chief regulator in Silicon Valley area, the San Francisco Federal Reserve, act here? Do you have confidence in its president, Mary Daly?
No, I do not. The Fed should have acted, both the San Francisco Fed and the Federal Reserve Bank. Remember, the Federal Reserve Bank and Jerome Powell are ultimately responsible for the oversight and supervision of these banks. And they have made clear that they think their job is to lighten regulations on these banks. We've now seen the consequence of this.
This was missing signals of what's out there. Do you think then, what's the consequence for regulators in San Francisco and Washington?
So, look, this is the point I've been trying to make all along. Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason. I said he was a dangerous man to have in this position.
You opposed him when President Biden reappointed him as well. You opposed him consistently.
I
understand that.
I opposed him both times.
I understand
That's exactly right. And for exactly this reason, because what he has done all along is lightened regulations on the banks.
Do you worry, though, in this moment where we
do,
have this crisis of confidence that you are sowing more distrust of the federal government right now?
Well, what I'm doing is being honest about what's gone wrong. I don't think you build any trust at all if you don't start with why it's broken and who it is, excuse me, that is responsible for that. We need accountability for our regulators who clearly fell down on the job, and that starts with Jerome Powell. And we need accountability for the executives of these large financial institutions. Look, there should be clawbacks for Gary Becker and the others who explode these banks. So you take back the bonuses and big salaries. We should, it certainly should, on both sides there should be support for this. And we should also bar them from ever being in banking again. We do that with stockbrokers. We should do the same thing with bankers.
Elizabeth Warren, thank you very much, Senator, for your time.
Thank you.